Welcome to If the Public Only Knew, the show that pulls back the curtain on what it really takes to build and lead a business. Host Gary Cinderbrandt sits down with some of today's most dynamic CEOs, founders, and leaders to dig into their origin stories, hard-earned lessons, and the missteps that nearly derailed it all. These are unfiltered, no-hype conversations designed to inspire, challenge, and fuel your own journey. Now here's your host, Gary Cinderbrandt.
Welcome back to If the Public Only Knew. I'm your host, Gary Cinderbrandt. Today we're joined by Christopher Volk. Those of you in real estate probably know exactly who that is. This gentleman has taken 3 companies public in the REIT space, all different stories, currently the chairman of Ten Corporation and the author of many articles on how companies should evaluate themselves. Chris, welcome to the show. I'm really pleased you're taking the time to talk with us today. I'm really interested, as we discussed before we started, in this whole concept of valuations and capital formation, 2 areas I know you've been heavily involved in. And I'd like to preface my questions against the backdrop of things that are evolving very rapidly. A lot of miscommunication, misperceptions, people fail to understand. But I think we can all agree that we're in an environment which is evolving very, very rapidly as far as how information is moved around, how data is utilized, things that are not being impacted by AI, not being impacted by AI. How does this all work together in your thinking going forward in what you're involved in now?
Yeah, well, first of all, it's just I'm really glad to be on your show. So thanks very much for having me, and I'm glad to meet you. So how does this all change? I come from the standpoint that uh, how I put this. I had a long-term business partner who said there are no new ideas in business or finance. Basically, it's the same ideas that just sort of get retread over and over again, and but the technology changes a little bit. And I think that there's some truth to that. So we're doing more with less. We're being more efficient with how we do stuff. The last company I started, I started with $15,000 of my own money, and had a group of people wanting to assemble a company, and we bought some plane tickets and whatnot, and were able to sell an idea and raise $500 million in the span of 3 months. So the answer is that you can start off businesses fairly quickly and from ground zero. And by the time I left that company, it had over $10 billion in assets. So we were able to grow that company, take it public on the New York Stock Exchange, and fund lots and lots of growth with that over the ensuing 9 years from the time we walked in and raised our first round of capital. So, today, I think with all the tools that are in place, and with all the money that's in place, there's no excuse for a good leadership team not to be able to do it. I mean, I'd say that leadership teams and good ideas are harder to find than money is. So the money can be found. It's just the good teams and the good ideas and the good business models. And I'm a total business model junkie. So those 3 things, finding good ones in those areas, that's the hardest piece. And if you can get a good team with a good idea and a business model that's kind of invented, it's conceived, you can sort of flesh it out, then your chances of raising money are good. And you're mentioning things like AI, and I know there's a lot of the companies you're talking about are companies that are doing sort of more with less. So they're doing asset light businesses and that kind of stuff. So heavy dose of intellectual property. But I would say that the companies I've done have some dose of intellectual property, but they've been very asset intensive because I've been in the real estate business. So they've been super asset intensive. So I'm here to try to promote entrepreneurship and to tell people that it's possible to optimize any business model. You just take the business model and do the best you possibly can with it, and that can make some serious wealth.
So if you look at asset-based pricing, there's markets, there's comparables that you can look at. But if you look at a company that essentially is a SaaS-based company, Alphabet is a good example of that. Meta is an example of that. There's no real hardware that they sell. Apple's a bit of a hybrid as well. But when you look at things like that, I guess a good example of that would be Anthropic or OpenAI. They're essentially SaaS-based businesses. Trying to place valuations on those, especially pre-revenue. Is that a $15,000 and a bunch of plane tickets and a good idea to find customers that are willing to pay for it first? Or are you raising capital and then trying to figure out if there's a customer?
That's a really great question. One of my favorite stories relates to Google, which you just mentioned, and when Larry Page and Sergey Brin started the company, basically they were doctoral students at Stanford University. They had an idea for a search engine, and they felt their algorithm for search for web search was better than anybody else's at the time. It was not far and away not the first early web search engine. There had been others, and they came up with this idea to do that. And once you create the idea and you find it, and you create that small box in the middle of the screen that allows you to search for whatever you want to search for, the question is, how do you monetize that? How do you make money off of that? Well, at the time that they had conceived the idea, they had no idea about the notion of AdWords, of being able to sell advertising on a word basis. And other people knew about web searches. They just didn't think there was a good business model behind it, right? So Microsoft was out there, other companies were out there. No one was getting into the space that they were pioneering, because no one really thought that you could really generate that kind of income off it. And along comes AdWords, and within 2 years they're billionaires. So you're basically have the idea, and then they created the business model after they had the idea. And so I think AI is kind of the same question. It's a really neat tool. Can you monetize it?
Well, I think it goes back to Steve Jobs. His attitude was, I don't want to build cool tech. I want to find problems I can have an impact on, and then produce products that are going to make consumers' lives much easier. So he went to the problem point and built it backwards. I think what I'm seeing now with a lot of AI is you're hanging together all these interesting processes, and at the end, you've got some pretty cool data moving around. But at the end of it, you're just looking at a bunch of data on a screen. What problem does it solve? And I think those companies are probably somewhat short-lived, as opposed to identifying a long-term problem and then building back to the solution. Because at that point in time, you're actually building for a customer that suffered that problem for a very long period of time. My question would be, let's assume that you see something like that. How do you value it? It's similar to what Google did with AdWords, where they didn't recognize that people had a desire to have ads thrown at them all day long. And yet off it goes. You can even go as far as talking about Bezos with Amazon when he left the investment world to sell books, and everybody thought he was crazed. How do you see that down the road as a nascent business model, which most people never see?
Well, that's a really good question, and I'm not sure I can give a good answer to it. I can give you a story, which is that first of all, when I left my last company, the largest shareholder we had was Berkshire Hathaway, Warren Buffett. So we sold him 10% of the company, and sometime back, I'd met Buffett a number of years before that at an event that he put on in Omaha, Nebraska, and it was a deal where you got to play like a hole and a half of golf with Warren Buffett, and then at the end of the day, you get to listen to him talk about the markets or whatever he wanted to talk about. And so, and this was in 1999, and the reason that's kind of fresh in today is because people are comparing the stock market bubble today with AI to the stock market bubble back in the late 90s with web-based companies and broadband-based companies. And So Buffett owned none of these companies, and people were just writing his case about why he wasn't investing in any of them. So, uh, and Warren Buffett being a fairly politic guy and not wanting to, answer in a confrontational way, just gave a story, which was that he had these slides, and they had what he called the two seminal industries of the 20th century, the biggest industries that impacted the 20th century, and one of them being the invention of air travel and the jet airplane, and then the second one being automobile travel. And he listed on his slides every public automobile company that ever existed, and there were so many of them. I mean, there were like 8 point, and there were about 5 or 6 columns of them. Nobody could read them. I mean, they were a PowerPoint slide, nobody could see them. And he did the same thing with airlines. I mean, there's so many public airlines that you couldn't see those either. And he made this comment that if you had gone long the industry, i.e., if you bought like stock, 10 shares of stock in every single one of these companies, you wouldn't have made any money. You would have made zero money. So you had to figure out, which companies were going to make it, and that was really hard to do at the time. So who was going to have the best business model? Who was going to be able to uh, uh, prosper? But the other thing was that it turns out that those industries, as big as they are and as important as they are, had fall off impacts because they impacted the oil industry, for example, that has to make gasoline for all these things. They impacted hotels, motels, real estate development that was going to be in the way, highway, transportation, road building. And so, AI, if you're looking at it in that same light, is potentially a ground-shaking technology that's going to impact a lot of industries, and perhaps AI is its own industry as well. But it'll fall off on a lot of other industries and have an impact there. And certainly we're looking at it at Tenet, and I'm on the board of other companies that we're looking at the applicability of AI to make what we do better, and make us more efficient and therefore more profitable. And then the question is, we're going to benefit from AI, no question. The question is, how will the AI companies themselves benefit?
Well, it's fascinating because you look at Google, and the more people that use Google, the better the search got. And Google started as a bunch of servers sitting somewhere that, they would buy servers from anybody and just run their algorithms to improve their search. But every time it got used, it got a little bit better. Spell check's a good example of that. Now with generative AI, which can probably write a set of wills and trusts better than a Harvard third-year student, um, you've got all sorts of things that are apparent and developing. But then now I see in the latest evolutions, you're moving from generative AI to AI that is actually starting to do predictions based upon frequency of mention, based upon ultimate feedback of correction. And I think the recent release of OpenAI's Chat 5.0, especially in the area of coding, it's remarkable. I mean, you're going to have 2 billion coders in the world who never learned how to write Python or a JSON file because you don't have to anymore. The thing will debug your code for you. So then it's going to move even further into estimating probabilities because there's going to be consistent data fed in that it can come back and look at. And that leads us into, I don't think we get the sentience or the singularity, but it gets to the point where you're having actual conversations with a machine that's answering you contextually and picking up innuendo. I don't want to say it's disturbing, but I'm always very polite when I'm having these conversations, just in case, just in
Yeah.
case. So I'm saying, please recheck your work. I always put please in there and I'll come up with something else. But it saved me, I would say, countless hours on the phone with various technical support drones who even of themselves are answering me with AI chatbots. So it's definitely changing what we're doing. When you look at how certain things became disruptive in industries, let's go back to REITs for a second. A billion-dollar REIT back in the day was the biggest REIT ever. Now it's probably you got to be compete to get listed at something that small. What did, as REITs came in as a methodology of ownership, tax favored dividend structure, corporate management, financing, right around the line, What were the underpinnings that grew that industry? You were there right at the beginning. What did you see happening that would allow you to take advantage and grow so much capital on behalf of yourself and others when no one else saw it? What did you see?
I saw lots of stuff. I saw that from a financing perspective. Let's say you're running a business and you're Amazon, hypothetically, and you have all these warehouse distribution centers. Amazon rents most of those. They don't actually own them. And if you look at AWS, I'm going to say that they also rent a lot of their data centers as well. Um, now Amazon has a choice. Do I own this stuff or do I rent this? I mean, and so my whole thing in my career has been to convince people that they're better off having a landlord than a banker. So they're better off being, renting the stuff as opposed to owning it. And there are a whole host of financial reasons why that's the case. And it generates, it's about sort of taking the Amazon business model and making it the best it can be. So, and they tend to be better off if they don't own the real estate. And so I was able to convince them to do that. And I think that I saw that as a possibility over time to be able to do that, to uh, take a REIT and effectively turn it into a shadow banking company. I mean, where you're not just, you know, Peter Drucker, the well-known business consultant, used to sort of say that what you have on your balance sheet is not necessarily what you do. So you look at a REIT and it's got like a lot of real estate on its balance sheet. You look at our REITs and we have lots of real estate on our balance sheets. And you might be tempted to think these guys are a real estate investment company. No, not at all. We were a finance company. We were basically a shadow finance company, and we were owning real estate as a means to finance it for other people. And so we saw that opportunity as well. And we saw that I had this belief, by the way, that most people, if they're any decent net worth, you probably have no business owning a lot of real estate. You'd be better off just owning a bunch of real estate securities. Because when you own real estate, you have a big chunk of your net worth in a very few pieces of property, and real estate's expensive. So, I mean, it's hard to diversify. And so I was creating not just a vehicle for financing, but creating a vehicle for people, for investors to be able to buy real estate in a passive way where it was safe, it was providing dividends, and it was providing cash flow growth, and they could use that in their retirement. So we were able to oftentimes beat the S&P 500 with a real estate investment vehicle. We were able to beat the broad REIT benchmarks every single time. We were absolutely able to beat private credit benchmarks. I mean, so if you think about a net lease REIT where I'm leasing assets to people, it's kind of like at the intersection of corporate credit and real estate. And so we were able to trounce private credit. And so we're able to give people a really reliable rate of return. And that's how you attract investors like Buffett.
So with that reliable rate of return, how much of the investor's mindset revolved around the tax advantage of the REIT dividend structure?
Almost none. And it's because most of our shareholders were tax exempt shareholders, right? So in today's world, the people owning your stock or money managers, they're Wellingtons, they're Fidelities. I mean, the people that were our biggest shareholders. We know we had a lot of retail shareholders too, but especially after Warren Buffett bought stock, we had a lot of retail shareholders. But for the most part, many of our shareholders were tax exempt themselves, so they didn't really care about the taxes. They weren't paying taxes. And I think, by the way, that the tax exempt structure of a REIT doesn't benefit most investors, even if they're taxable, because all that structure means for them is that when I tick off the box that says I'm a REIT and I'm electing to be a REIT, the good news is I get a tax deduction for dividends, which companies don't otherwise get a tax deduction for dividends. So it's not that you don't pay corporate taxes, but you get a tax deduction for your dividends. And so effectively you don't pay corporate taxes because you pay out dividends. But the thing is, you got to pay out 90% of your taxable income at least in the form of dividends. That's a lot of money. I mean, you're forcing yourself to pay out dividends. And the reason Berkshire Hathaway owns very few REITs, for example, is because Warren Buffett doesn't necessarily believe in dividends. I mean, Berkshire Hathaway itself doesn't pay a dividend, and what he does is takes his cash and recycles it and compounds it. And you look at all the great tech companies and stuff like that. Some of them pay dividends today, but most of them don't pay a lot of great dividends. They're taking the money and just plowing it right back into the business.
So you were dealing with a lot of tax exempt investors earlier on. Did you felt restricted? Did you feel restricted at all because you couldn't leverage any of your assets because of UBTI?
No, you can leverage stuff in a REIT, and there's no UBTI issues. So the
Even
answer
to
is
a
no.
tax exempt investor, they're not going to
Yep.
get whacked with anything.
They don't care. They don't care. Our leverage was not high; it was 40%. But yeah, there's zero UBTI issues.
When you look at that market today, where interest rates are, um, most of your capital's equity anyway, which lends more credence to the fact that it's better to deal with a landlord than it is a bank. What's the impact been on the supply side of new supply coming on, new financing, with interest rates having been persistently high over the last couple of years? Do you think that makes your properties more valuable going forward? How do you anticipate the impact on what's already built versus projects you'd like to see developed?
Yeah, so I've never been a development guy. The great thing about running a net lease REIT is that we've got no architects on staff, we have no property managers on staff, we have no engineers on staff. We were running $10 billion plus worth of assets with 120 people, so it's super efficient. I mean, when I was in commercial banking, I left this bank that had $1 billion in assets and we had 1,000 employees. And they just put and we had no branches, so you're like a non-bank bank with no branches. I mean, just one place. So it's exceptionally efficient in terms of what you're doing. And and we did not develop anything. What we did was we worked with many companies who used real estate every day in their business. And they could be manufacturing companies, they could be service-based companies running fitness clubs, veterinary clinics, whatever. I mean, we did ski hills. I mean, I've owned all kinds of stuff over the years. But these are companies that are what I would call real estate intensive. Oftentimes they have a lot of real estate that they need to have in their business to run it. And if they wanted to develop a new location, they would hire a contractor to go out and do it, or get a developer to go find a location for them and do it. And sometimes we would finance that development. But we never chose the site and we never developed it. So we were never doing anything speculative at all. And I would say probably 90% of what we did was dealing with pre-existing real estate. So we weren't really worried about what the new supply of real estate was, because nothing that we were doing was speculative. So if you're dealing with multifamily or something like that, that's when you get interested in supply. I mean, when you're dealing with uh, ground up strip shopping centers and you're competing with one another, those folks are interested in what the saturation levels are in marketplaces and what the supply is. If you're us, we're just a finance company. And we're not buying, we're not competing with other people to buy and develop assets that are competing with other newly developed assets. We're just there working with our tenants, and they could be in the chain restaurant business, or they could be veterinarians that are making your dog better. So
Sure. So coming from a background in wealth management, I was fortunate. I made a lot of my mistakes early, and I was smart enough to go find people that were way smarter than me and just shut my mouth and listen and get a lot of good advice from people that really knew what they were doing. And I was fortunate to really have a career where I had great impact on a lot of people, um, families that I just literally grew up and older with. And one of the things we always talked about was you could take a top wealth management professional at any firm, any large firm, and you could take everything away from them. And you could give them a bunch of quarters, and if you can find a phone booth in the middle of nowhere, they would go reconstruct their business basically out of that phone booth. Imagine for a second that that's you, and knowing what you know, here's a bunch of quarters, there's a phone booth that still works, and you want to go rebuild or move along the same lines. But with all your accumulated knowledge and wisdom, who's your first phone call to? What do you do to get that thing moving from a dead stop to something along these lines down the line, knowing what you know?
yeah, so you have two. two types of companies, I guess. You got bigger companies and smaller companies. And the companies I've started have all been bigger companies. I mean, we were, when you're in the real estate business, you have to raise a lot of money. Raising a small amount of money, if you're going to be in a business that's tech and AI driven or whatnot, you might be able to get by with raising a very small amount of money or doing something out of a garage. I couldn't do that. I had to raise lots of money. And so you got quarters, and your first couple quarters are making calls to people to say, hey, you want to start a company? And how'd you like to be the CFO? And people you might know. So you have to assemble a team. And then with that team, you're going to put together a kind of a business plan. And your next calls are going to be to asset management investment types. And there are 10,000 private equity firms in the United States today. I mean, when I graduated from college, by the way, there were like zero. I mean, so it's gone from 0 to 10,000. I mean, these are not just private equity; they're venture capital, private equity, all kinds of asset management companies. And they all want good ideas, and some of them have specializations, but you can find some people. In my case, the list of asset management companies is maybe a page long that you might call. And so let's say 25, 30 companies. And my next quarters would be spent setting up appointments to go meet with a handful of those guys to see who'd be interested in doing this. And picking a partner is an important thing. I mean, you want to pick. Not all asset management companies are the same. I mean, they all have their own corporate cultures. They all have their own ways of running businesses, and they all have their own flavor of capital. It's not always quite the same. So it's important to find someone that works with you. And if you have a good team and you've got a good idea, I'm convinced I could be in the middle of nowhere and get in the phone booth and find the money.
So it's the idea, it's the team, it's having the quarters actually. Finding the phone booth might be the most difficult aspect of that entire exercise.
Yeah,
Um,
exactly.
but it's fascinating because it's incredible because the more things change, the more they stay the same. Because let's go back and look at somebody that's got an idea that's going to revolve primarily around IP, solving a problem or creating value on behalf of others. Develop the idea, meet the need or the pain point, find the team that can actually deliver it, and then go to your logical investors slash buyers and say, hey, if I can deliver X, Y, and Z, would you pay me A, B, and C for it? And they say, well, yeah, great. I'm coming back next month and I'm going to deliver it. And if it works the way we say, will you do this? And they go,
Right,
yeah, why wouldn't I? And,
right.
you know, it sounds easy. I know it's not. And there are certain qualities that you have to get through that because you're going to meet a lot of no's along the way. If you're talking to an entrepreneur or someone that's considering leaving what they're doing, which is could be nice and safe, dependable, you took these risks when you were younger, which is great, but you've got somebody that's just miserable in their 40s and they know there's something better out there for them. What do you tell someone like that? It's a good idea. They can get the team, make the jump, or work 20-hour days
Yeah.
with
So
two
so um
jobs.
so you and I just talked a little bit before we got on, but when I started off in banking and decided that I didn't want to stay there, and so I uh, ended up working with a company that was kind of a nascent, growing, company that was out in Arizona. So I moved from Atlanta, Georgia, to Phoenix, and the company I was tying my future to was something, I don't think any Ivy League student would go there. It was it was a definite startup in so many ways, and but I liked the business model. I liked what they were doing, and I liked the problems they were solving. To your point, every company solves a problem for somebody. So I liked the value add they were giving in the problems they were solving, and um, so I did that. So I ended up becoming president of that company. I took it public for them, but I didn't start it. So I was entrepreneurial enough to work for a growing company that was early stage company, but but it wasn't entrepreneurial in the sense that I didn't start it. And so we sold that company ultimately to GE Capital, which had 350,000 employees at the time, and I couldn't begin to work there. So I ended up leaving GE Capital, and I had offers to go work, with other companies. And I decided at the age of 47 to start one myself. And I decided to start it in something I knew, which is kind of what we've done in the past. And I decided I'd had enough Rolodex to do this. And I think that if you're in your 40s, part of why you do this is because you think that you have enough knowledge to pull this off. I mean, you have gained skill sets. I always find that careers tend to progress in a pattern where your knowledge builds on itself, and you're collecting all this knowledge, and that knowledge can be monetized. I mean, so one of the biggest assets that we all have is just this fountain of knowledge that we've created in our heads. Um, so I so I decided, okay, I'm going to try to monetize this knowledge that I have in my head, and be able to start a company. And uh, and I decided I'd rather make less money working for myself than more money working for somebody else. And I decided that I was doing it in part because I didn't want to be like 70 or 80 years old looking back on my career saying, holy crap, you could have been doing this when you were 47. You could have done this, and you wimped out. You just like you didn't take the chance, and I would have felt kind of incomplete not having taken the chance. So I think that for me, it was partly seizing this opportunity and forcing myself to seize it and take that risk. And I had positioned myself to do that because I had a low nut. Like if you're going to be an entrepreneur, you shouldn't have a lot of debt, and you should have cheap cost of living, so that I could sort of make by on not making any money for a while. And you know what? If it had all failed and I hadn't made it work, I would have been going back to work for somebody else. I mean, and that was my downside. That doesn't seem like a lot of downside, does it? I mean, it seems like you should take that risk.
So a couple questions. So we use the word risk frequently. It's used in wealth management. It's used in any type of investing. What's the shortest definition of risk you could give me? The fewest words of risk in your view?
Margin for error.
Okay. Kind of go there a little bit, but it also margin for error goes to the other side. It also could be margin for success,
Uh,
right?
totally. But if you're saying risk, risk is sort of I view risk as sort of downside. So, what's your downside risk? What can go wrong, and if it goes wrong, like how much can you lose from that? And when I'm raising money from people for our businesses, I would try to think like if I really screw up, what can our shareholders lose? And with a lot of true venture capital business, I mean, shareholders can lose everything. I mean, when you start
Yeah.
a business, in the businesses I was starting, I thought I could generate, annual returns for investors kind of in the 20s. Um, and I thought that the downside risk was 9, something like that. And so nine's better than most of these guys have. If you're a pension fund, your actuarial return assumption is not even a 9. So 9 for a downside risk is pretty good, and on the other hand, a 22 or 25% return on the upside isn't as good as where you would have been with Google or something else, but it's okay, so it's a good number.
It's funny because when I used to hire outside money managers because I just didn't really want to bother with trying to do all the research, I didn't look at their past performance. I looked at how much of the market are you capturing when it goes up, and how
Totally.
bad of a beating are you taking when it goes down. Most people
Exactly.
never think about the mathematics of loss. They say, well, what's that? Okay, here's $100,000. I double your money, you're up 100%. Oh, great, I have 200,000. Now you're back down 100%. Where are you? They're
Right.
like, 100,000? No. And you can see the wheels start to turn. When I was in wealth management, I would go through a process before I'd onboard a client and make sure we had an agreement as to what definition of risk actually is. Look it up in Webster's dictionary. It's a possibility of loss, damage, or injury.
Yes.
The
Yep.
magnitude is what most people misjudge. Like I'm sitting in Colorado right now. I doubt a meteor is going to hit me anytime soon, or an earthquake, or I'm going to have a
Right.
tidal wave. But is
Right.
the risk zero? No, it might be infinitesimal that I'll get hit. But if I'm sitting in the middle of the ocean, there's a high probability if I don't have a boat or a life jacket, my risk is completely different. So I think most people view risk as an emotional response to their most recent event. It's kind of hard coded in that way, and I
Well,
think a lot of times it gets in an investor's way.
in business school, they teach you that that risk is volatility, right? And then of course you've got the VIX index, which measures volatility. So people look at the VIX index as the measurement of risk. Um, and for people that have been in business, I mean, none of us, I don't know anybody who looks at as volatility as risk, return, valuation volatility as risk. I mean, it's a ludicrous concept to me. And so when I say margin for error, it's kind of like when people look at companies that are highly leveraged, they have a lot of debt on their balance sheet, and they say, well, that's risk. Could be risk, but I've seen plenty of highly leveraged companies do really, really well. What it really is like what can go wrong for them not to, for that leverage to have an impact. How many mistakes can they make? So not all leverage is created equal. And so when I'm thinking about margin for error, it's like what can go wrong, on the downside for stuff because I do not believe and have never believed that volatility is equal to risk. I think it's
No,
a
I agree with you.
hugely
I
bad
totally agree.
measurement.
I think it creates opportunities if you can be responsive to it. Just a couple of more questions, if I may. Um, as far as your past liquidity events, the sale to GE Capital was probably a great day when you did it and a better day when you got out of there. Is that fair to say?
Yeah, I mean, it was. I actually had some misgivings about having done it. I think in retrospect, if we kept that business and not sold to GE Capital, we probably would have done better over time. I think that in some respects, we were impatient. I mean, we made money, so don't get me wrong. So like we all made money, but I think we might have actually done better if we never sold it. And part of why I'm saying that is because GE was a lousy owner. So when GE bought the company, they didn't make it a better company; they made it a worse company.
I had a guest on a couple of weeks ago, Mark Rampala, who's out of Dallas. Mark left International Paper in his early 40s and basically launched a company that sold coconut water called Zico, Z-I-C-O. You've probably
Uh-huh.
seen it.
Yeah.
Bunch of years later, he sells it to Coca-Cola for $200 million. Great day. 3 years ago, he buys it back for $4 million and takes it back over, which is a hell
Yeah.
of an arbitrage because as you found out with this massive company that you sold your business to, just because they have a lot of capital doesn't mean they know what they're doing. Um,
No, they destroyed it. Yeah.
yeah, and so now he owns that again, and he runs a kind of a mid-tier A and B round venture firm. Taking companies public for liquidity is no picnic either. The amount of regulatory requirements you're responsible for, the fiduciary responsibility you take on, and you've been through that a couple of times. Was that everything you hoped it would be?
So I did it three times, uh, and the first two times I had sort of a love-hate relationship with being a public company because when you're on the New York Stock Exchange, you have this one source of capital, which is New York Stock Exchange capital, and it can be good some days and it can be really bad other days. Uh, and uh, and you're dealing with investors that fundamentally are short-term in nature. And I would tell you today, like so few people read financial statements or know what companies are doing. I would say with my last company, like two-thirds of the daily trading in our shares was done either by machines or people that had no idea what we did for a living, which is kind of scary when you think about it. I mean, in terms of who's driving the market, is it smart money that's driving the market, or we got these two-thirds of the market being driven by people that don't know what they're buying? So um, anyway, I decided that when we took our third company public, I kind of had this religious experience about that, and I just thought, I could do this a bit, I could be better at this, and I was more accepting because I'd taken these two public companies that I ran that were good public companies, sold them to people that basically didn't make them better companies, and I thought I shouldn't have sold these companies because ultimately they weren't better for having been privatized. And so with the last company, I thought, okay, I'm dealing with short-term investors. I got a short-term mindset. The market the market steers you to a short-term mindset. So for example, if our stock multiple was like super high, it was kind of like the market telling me, go buy anything, buy a lot of it, go issue more stock. I mean, the market's sending you these buy signals that you should do this stuff. And as a CEO, your job is to say, no, I'm not going to do that. In fact, I'm going to stay to exactly what we're doing and say exactly what the game plan is. And I'm not going to avail myself of this, essentially free money out there and go raise more stock to buy assets which have lesser returns, frankly, I mean, than what we would otherwise do. So we're going to stay to the game plan. And so the issue of like making sure you get people geared to what the long-term game plan is and stick to it, irrespective of the fact that you're in a short-timers marketplace where a long-term investor is like lunch. And then if you can do that, if you can articulate that, then you'll get some long-term investors. You'll get a Berkshire Hathaway, or you'll get other people that are long-term investors. They'll just sit on the stock and like let it go, and that's what I was into. I was into people that were going to own our stock, understood the fundamentals, understood we had a great business model, understood we had a moat, and they were going to stick with us, and that's what I wanted to go for.
So primarily, since you weren't really involved in debt or any of the exotics, um, I'm sure you had some asset devaluation in that '07 to '09 period. What were your thoughts when you saw those two big real estate hedge funds crash? I think it was either Credit Suisse or one of the other firms. When you saw these things start to fall apart, they were backed up with kind of spooky debt. Were you on the sidelines? Were you opportunistic? Did you think we were going to be talking about bullets and water the following year?
Yeah,
How did you
yeah.
view all
So,
that?
so I'm a capital markets, I'm a capital markets expert, somewhat of a capital markets expert. In the companies that we did, I mean, not only do we tap into the equity, and of course we've tapped into all kinds of different equity, whether it's retail equity or institutional equity or whatever. But then I've done unsecured borrowings, and I've done different flavors of asset-backed securities borrowings. So I've done, mortgage-backed structures with tranched credits going from AAA down to unrated. There's an item called a master trust, which is how people finance credit cards and student loans. And today, master trusts are being used to finance data centers and all kinds of stuff. And I did the very first one of those on the real estate side back in 2005. So when I'm looking at some of the mortgage-backed structures that are failing, in most cases, these are structures where there was just excessive amounts of leverage. And I mean, a lot of the stuff fails for the same reasons that things have failed throughout history. I mean, people either made wrong interest rate bets, which people do, or they just leveraged too highly, which they also do. And so they had no margin for error, and oftentimes they didn't know they didn't have any margin for error, but it turns out they didn't. And so the question is how to structure yourself. I mean, and to have a margin for error. So, today the company I'm chair of, our leverage is approaching 70%. The company that I ran as a public company was levered at 40%. 70% is okay. We can run at 70%. I mean, I think we have good margin for error at 70%. We can cover our debt payments by a factor of 2. I mean, I think we got lots of room. So, but that's, so not all leverage is created equal. You have to really evaluate it.
Do you think most people understood during that period in '08 how close the entire system came to just seizing up?
No, and I think also, that there are lots of lessons from '08, and I'm not sure we've taken, paid enough attention to some of these lessons. I mean, the biggest lesson for me is that alignment of interest really matters. In the case of '08, you had all these mortgage-backed securities being created and sold, and the people creating them had no equity in the game. The mortgage brokers had no risk in the game. Basically, all the risk was being borne by investors, and the rating agencies themselves fell asleep at the job. I mean, they weren't. Not only did they allow all this to happen with no alignments of interest, because you can't trust data. Like you can't trust performance data that's historic if there's no alignments of interest. I mean, because that data can change. I mean, I just don't trust any data if there's no alignments of interest. People will do kind of what they're paid to do, and in this case, people did some very risky stuff. In the book, The Big Short, there's this great scene. Oh, and in the movie, there's this great scene where Steve Carroll, who's playing one of the hedge fund guys, I can't remember whom, he said he goes down to Florida and he's dealing with mortgage brokers and finding out they can sell cancer. But then after he does that, he goes to a strip bar and he gets a table dance from some
Right.
woman who owns like 5 houses and she's got
Right.
5 mortgages. And she's got what's called a ninja loan, which is no job, no unemployment, I mean, no nothing. But she did it 5 times, right? And so when he sees this, he goes, "Let's go short the market. The whole market's
Yeah.
busted, right?" And I'm thinking to myself at the time, I'm going, "Well, where were the rating agencies? They didn't go to Florida. Like none of these people got off their ass and like actually went to Florida and checked this stuff out." And so when people are saying to me, like, when they're concerned about people not having gone to prison in New York, and there might have been some people that deserve some jail time, but I would say that a lot of the CEOs of the banks, and you were at Bear Stearns, or I think, or
No,
were you at Bear or
I was
no?
at Merrill Lynch.
Merrill, but
I was at
that, but
UBS Private Wealth at the time, but
yeah,
UBS
but
was caught up in that also.
yeah, I mean, but anyway, I would say that the guys who were ahead of these, Ace Greenberg at Bear Stearns and Dick Fuld at Lehman Brothers, they had no idea that they were betting the ranch on this stuff because all the corrupt mortgage practices that have been created by guys that were vice presidents. They were all Ivy League students, and they came, they were like 2 or 3 levels down from them, and the rating agencies that allowed all this stuff to happen. They assumed that a AAA mortgage was a AAA mortgage. It had AAA risk to it, and
Yeah.
it ended up not having that at all. I mean, the AAA was a bunch of letters on a piece of paper, but it no longer really represented the kind of risk that was being taken.
Everything looked great until it didn't. UBS was primarily responsible for keeping Lehman Brothers propped up by doing offshore repos where they would lend against par value instead of market value. And they would just reverse it. So they lend in England where you could lend against par, and they'd
Yeah.
reverse it at the end of the day and take their vig. And Lehman would say, "Look at all this cash we have. We're in great shape." I was
Oh yeah.
actually
Well.
the one of my clients was the lead attorney for the reserve fund, and he called me just before they announced they were going to break the buck. And he said, "How quickly can we get it all into government securities?" I said, "It's a button push." He said, "You got to do that for everybody." I was like, "What's going on?" He goes, "I got to go now." Um, and that was the same week the government voted down the rescue package the first time. I called my congressman up. We had an hour and a half conversation where I literally had to explain how you get to 25% unemployment when a money market fund breaks the buck. And he was
Right.
like, Paulson came in and they said, "You got to sign this right away or the world's going to go to hell." He goes, "I couldn't sign that." I'm like, "Frank, they're right. You have to go sign that." And fortunately, the Fed stepped in, which is when you had to have the Fed step in because I don't know what would have happened had they not been there. Um, I don't want to say that lightning's going to strike again, but I'm always of the mind that there's something out there that we're really going to become educated about after it happens. Everybody's going to be able to explain it, but we're not going to know it until we go through it. Do you ever get that feeling?
Well, that's what happens. And so I was in 1998. We had long-term capital management, which you might remember, and that
Very well.
was a huge event that the Fed had to get involved in as well. And then you had the 2007-8 issues, and we haven't, and of course we've had COVID, which basically was where you stopped the economy. I mean, you told everybody to stay home and not work, and that'll have an impact on the overall economy when there is no economy. But uh, so I'm, absolutely convinced that there are risks at play today, and I get concerned about it personally from an investor perspective. So, um, I'm concerned about the values of public equities. I'm concerned about the values of private equities. I'm concerned about the inflation of AI stocks. Uh, I'm uh, I'm concerned about the fact that 40% of the S&P 500 value lies in 10 stocks. And And so what happens to the gravitational pull on the S&P 500 if those 10 stocks fall out of bed? Um, and so I'm concerned about digital currencies, and what's going to happen with unregulated digital currencies, as far as I can tell. I think that there are a whole host of risks that are out there. I'm concerned about the potential of having public trading in private companies, or public ownership of private companies that are non-listed. I would tell you that when I look at, for example, untraded real estate investment trusts. So let's say you have listeners that are owning private real estate that's sold to them by some big Wall Street house. Um, uh, Typically, those private funds don't have the same kind of reporting requirements as public equities would have. So if I'm running a public REIT, I'm sitting there doing quarterly earnings calls. I've got quarterly presentations. I've got, discussion about how protected your dividend is, where your return's going to come from, what's gone wrong with the companies. When I see these private companies today, they have nowhere near that kind of disclosure, just zero, and it's a very risky time for me when I see that kind of stuff.
And one of the things that I think is actually fueling that are a lot of the sponsors. They are now distributing a lot of their alternative investments in private equity through these bigger platforms, and they've kind of changed the revenue shares. They've changed how they pay the advisors that sell them into their client portfolios. It's incredibly profitable for the brokerage firm, but the liquidity is basically zero. And then they tell you, liquidity whenever you want it, and then all of a sudden everybody wants it, and oh, there's a gate. You got to wait. How long?
Oh,
We don't know.
totally, totally.
And so
Yeah.
you find out
I
at the
mean,
end, at the beginning, we used to say the limited part, or at the beginning, the general partners got all the wisdom and the LPs have all the money. At the end, that reverses.
well, the private deals are often sold on the basis of reduced volatility. They're trying to sell volatility as risk, and so because something's private and it doesn't trade every day, um, you have financial advisors who have been taught that somebody could be sold this product because it's not a volatile product. But in fact, it's every bit as risky. And in fact, it's probably more risky because the private companies, if they're in there, are more highly levered than the public companies that they could buy on the New York Stock Exchange. The private real estate is likewise much more highly levered than it would otherwise be if it were on the New York Stock Exchange. The front end load is incredible. So in the
Hmm.
private real estate space, oftentimes the brokerage fees are 3.5% up front, and then they pay like another 75 basis points a year. So you end up with like 9%, give or take, worth of brokerage fees. It's the most, fee-rich product that people can get, right? So if you're a financial advisor and you're making 9 points selling something, it's just extraordinary. So, but meanwhile, if you're the real estate company and you have 9 to 11 points worth of leakage up front, and you're only
Yeah.
investing like 89 cents in the dollar in the ground with higher leverage, there's not a chance that it can have a business model that comes close to the business model of a similarly situated, decently run public company. It just couldn't begin to
I
touch
couldn't
it.
agree more. I just don't think there's enough juice in it to justify that level of illiquidity. Because the first time a client says, well, when am I going to get my money back? And you say, I don't know, your credibility goes right out the door. And I know that, from an institutional standpoint, there's hundreds of billions of dollars in these things. You mentioned something before, and I do appreciate the time you're taking. This is fascinating. Looking at public PEs right now in that 26 to 30 range, you can look at statistics going back as far as statistics go, which tell you that the 5-year forward return, if you make a market entry here, is 3 to 5%. And yet there's
Right.
people out there on the other side of a trade every single day. I would have rather bought it in '09 when the PE was 10. Basically you were looking at double digit returns as far as I could see. But it doesn't seem to matter. I think one of the things that I'm very concerned about from the wealth management side, I was fortunate because I stopped chasing returns early and started chasing outcomes. You need X amount of money and Y amount of years. What return do we need
Yep.
to make that happen? And if it
Totally.
was a six, it was a 6% return. Okay, I'm going to get 8 from my equities, 4 from dividends, 4 from mostly growth, and I'll get half from bonds, maybe. I'll put the two together. I'll put half my money in each high quality, and I'm going to let it go. And then all of a
Yep.
sudden, my equities run up by 30% over the first 2 years. So it finally dawned on me, I need to ask the question that if that money were coming in today and the client had the exact same goals, would I put them into a portfolio that's 70% equity? And the answer is no. I wouldn't even need 50%. I might be able to do
No,
30 or 40.
totally.
So
And then also the question is what kind of equity, right? So um, would load up onto ETFs and buy like the Russell 2000 or the S&P 500? Maybe not. Like
no,
I've
I
decided
never
that.
I never made a hard bet. I'd be large cap growth, large cap value, some SMID, some international, and then bonds that had maturity dates and coupons. As simple as it could be. But what's happening now in my world is that a client that was 60 that was on track to do everything they wanted with a 50-50 portfolio, they're now 70 and they got 65% in equities. They're still on track until the market declines 20%, then they're out of money when they're 80. And brokers are just sitting there looking at it going, well, they're making money, I'm making money, I'm going to leave it alone. And I'm looking at my consulting clients, I'm saying, you guys are idiots. You don't need, you're not going to lose any fee, you're still going to get paid. But why are you taking risk that has no outcome?
Right.
And they kind of look at you like, well, the client really likes what's going on. I said, you're actually listening to your client? That's the worst thing you could do. So,
Yeah, I mean, I agree that you go after outcomes. Like, I'm 69, so I haven't been drawing a paycheck for a while. So, and when I'm looking at my own portfolio, I'm not trying to beat the S&P 500. I don't really even care, and and the thing is that if you're debt free, if you're fortunate enough to be debt free, and I'm pretty debt free, then then inflation hits you a lot less, right? Because so much of inflation is tied to your cost of living, right? So if you've covered your house, if you don't owe anything on your house, that's always a good thing. And ideally, when you're getting older, you want to put yourself in that position. So um, so I'm not really worried about necessarily beating inflation. I'm worried about being able to live till I'm 90 plus and or whatever and have money to spare, hopefully. Uh, and and so what I need to live on, I need to have income and I'm not counting on capital gains, right? So I'm not gonna load up on stocks. As much as I like Berkshire Hathaway, I wouldn't like be loading up big time on Berkshire Hathaway that pays no dividends, and I'm counting on capital gains. I need to have enough. I do have some Berkshire Hathaway, but I want to have other stocks too that pay a dividend. So I have enough dividend income and bond income that can kind of cover my lifestyle, and then I got this other stuff out there. And if I do, uh, if I do okay with that stuff, then maybe that's great. But I otherwise I know how to live off of this stuff, and I can't. When people are trying to beat the market or even equal the market, I think that at my age, that's not what you want to do.
I don't think at any age it makes any sense. I'll leave you with one thought that I teach every advisor that I work with, that they need to ask themselves and their clients, when you look at your portfolio at the end of each month or anytime you look at it, can you match everything you own to what you need or want that money to do? And if the answer is, I just want it to make more money, that's not a good answer. I think that
Yeah.
you are uh, learned a lot of lessons along the way, probably many more than most. Chris, this is just fascinating. I could talk to you for hours. Thank you so very much for coming. I hope that you enjoyed this half as much as I did.
Well, Gary,
Uh,
it's my pleasure, and it's so great to meet you and to chat. So,
Wish you nothing but the best in the future. We've been
you too.
visiting today with Christopher Volk. I don't even know how to describe him. Someone that is at I'd say the top of the stack, not just in the real estate market, but in financial wisdom overall. You can check him out online, check out his books. He's on X, he's on Instagram, he's wherever you want to look. You can find him on TV as well. Chris, thanks once again. Hopefully, we'll talk to you
Gary,
again real soon.
likewise.
Thanks for tuning in to If the Public Only Knew. Don't forget to follow the show and share it with anyone who's ready for the real raw stories behind the business successes. Join Gary next time for another powerful conversation that will leave you inspired and ready to take action.